The increasing international crisis in Europe and the Middle East has influenced global markets in negative ways. Surging inflation and rising interest rates also heighten tensions in the financial markets as investors seek safe haven for their funds. Well, I'm not doing this alone as usual. I introduced them earlier. Joining me to look at these key issues is the Chief Executive Officer of Finance with Muktar, Mr. Muktar Muhammed. Thank you so much. It's good to have you in the studio. Good afternoon.
Thank you, Tulu. Always a pleasure to be on your program.
Thank you so much. We appreciate your time every time. We appreciate your contributions every time. Well, we have a lot of crisis on our hands. Let's tell ourselves the truth. From Ukraine, we're talking about that now, Israel, Palestinian, and even Africa. A lot of issues everywhere. Now, let me ask this way. What sort of effects do you think this has on international business and investment?
You know, they said when a crisis comes in, even if it's not supposed to affect the market, because the world has become a global village, and then you see what ordinarily shouldn't be a problem now becomes a problem. Now, I don't see any reason why global market should be having crises at this moment, because you're looking at Israel-Palestinian crisis, you're looking at those crises are not crises that will have to affect the consumer perception or goods from Israel that will be coming in. But again, you see those crises not turning if you now start to have the Middle East, maybe you get Lebanon gets involved, then oil disruption comes in, then we have a global crisis. So I think that's what people are scared of, not because of the Palestinians. When you look at the contribution of Palestine and Egypt in the global economy, it's not so much of an issue. But those surrounding them, you look at Jordan, you look at Egypt also is still there. You could pump a Middle East crisis. And once Middle East crisis comes in, then oil volatility comes up. And I think that's what the United States is trying to avoid when Joe Biden said he was going to visit some of the Middle East countries, even at the 11th hour, that was canceled. So I think global market will panic. But again, when global market panic, sometimes is now calls for opportunities for those people that play the global market to begin to take position, because the long lines at the bottom lines will still be good, but the perception itself is the problem, not the bottom line. And when you're an investor, you go beyond perception and you look at the bottom line.
I think that's for guys with the big cash, because you're not talking about small cash here now when you're doing international.
Well, international trade investors are those that have the big cash. Talk about institutional investors. But again, you mustn't forget that the world has become a global village. Some people are trading internationally right here in Nigeria with as little as $100, $200, and still making their moves there. So
True. But I'm not looking at this market, markets in Middle East generally, let's say Egypt, Saudi Arabia, Jordan, Israel, and Qatar. Can they return to profitability with investors' confidence?
Yeah, if they don't get involved in a crisis. You see, when you look at Qatar, you look at those the big economy in the Middle East, you look at UAE, you look at Qatar, you look at Saudi Arabia. Those happen to be one of the three biggest economies in the Middle East. Now, when you look at those three big economies, what affiliation do they have with Hamas? Now you begin to look at that, you zero it down. Then you look at, when you look at the Middle East now, UAE do not have any affiliation with Hamas. As far as UAE is concerned, Hamas are not even, when you are trying to Hamas, then you go to Saudi Arabia. Because of the Iranian connection in Hamas, the Saudi Arabians are not interested in anything that has to do with Hamas. Now you go to Qatar, that's where the problem will be, because some of the Hamas leaders are staying in Qatar. And so that will be a major challenge if they start launching attack, or if most of them are wanted and they're in Qatar, and Qatar and I say, look, we cannot release them to the international committee. That's where the challenge comes. But if you have three big economies and you just have only one, that could be an issue. It really be a challenge. Because if you look at Iran is already more or less like a nation that has been secluded from global economy for a while because of the tension and everything. So if they were still there, then you have that challenge. Iran, when you look at Iran is not saying anything, because part of Iran is still controlled by the United States of America. They have full control over there. And so they are on ground there. So Syria is almost like non-existent in terms of global economy. So definitely, you look at UAE, you look at Saudi Arabia, the two biggest economy in the Middle East is UAE and Saudi Arabia. Then you add Qatar. And if those two big economies in the Middle East are not really interested in what is happening. I mean, do not really have too much impact. What is happening in Palestine and Jerusalem has not so much impact on what is happening to them there.
We also see inflation rates beginning to taper somewhere. I think in the United States and even in the UK. That's not happening here in Nigeria, I know. But how is that also impacting trade and investment?
When you look at inflation figure, you see, if you want to compare their inflation challenges with our own inflation challenges, then they are looking at supply chain destruction. That's what caused their own inflationary challenges. But when you're looking at Nigerian inflationary challenges, what caused our own inflationary challenges? We are looking at microeconomy instability. We are looking at demand and supply instability, and added to it, we have FX volatility. So that is really, really affecting us. But our own has to do with the supply side of the economy. And so you see those coming down because when you come to supply, then you begin to add up, you begin to raise rate, you begin to look at how you can slow down liquidity circulation, you begin to look at other variables, increase spending, really reduce spending. But when it comes to ours, I keep saying that our economy is peculiar. We shouldn't do the copy and paste that we see the United States and others are doing. They have a peculiar situation. Yeah. Their situation is not structural. Our own is structural. Production and inflation due to high cost of diesel, high price of food item due to high cost of transportation. They don't have those barriers. Then exchange rate volatility. They don't have those challenges. So we need to begin to look at in-house solution to our own economic challenges. And the first we need to address is how do we attract FX into our economy? How do we bring liquidity of FX into our economy? So it doesn't care how we're going to get it now. Everybody have complained before that you borrow. I think as it stands now, if you have to borrow FX into the economy, you need to bring it in to create stability first. And after stability, then you begin to attract the right type of investors. Portfolio investors first, then foreign direct investors will definitely come in. There's still opportunity in Nigeria, but the volatility is not making them to come in yet because they want a two-way exchange system. They don't want their money trapped like some of their colleagues have their money trapped for the past 4 years.
Let's go back to the global market and see the banking issues. Look at the banking at global level. American and European banks, they are at the moment preoccupied with managing funds in and out, of course, following the crisis. Let's now look at what happens if repayment becomes impossible. We know what's happening in China, housing funds and all of that. Would there be a global economic crisis if this happens?
Well, there should be a global economic crisis if we begin to have payment issues. And like I said, trade has gone globally. And if I have to do trade and I can affect payment, then you begin to see that what we call a cash crunch. And once cash crunch comes into the system, then there is going to be a big effect. But now, look at it this way. Their government have the government have the big, what I call the heavyweights to really intervene in terms of liquidity when it comes to like that, because it's once it's a payment system, it's issues, not the structural issues. So those are what governments can come together and begin to look of means to sort it out. But when you becomes a structural issue that has to do maybe too much debt, you can't pay your debt, you cannot pay. You don't have the funds to again do business within yourselves. Yeah. So that becomes a major challenge. But as it stands now within the banking, if that challenge comes in terms of payment, I think that the European bank, the European Central Bank will come in, American banks will come in, and they begin to look at common solutions to those problems, because that is not a structural problem. But when it comes to structural problems that have to do with trade disputes and payment system, then we may trigger a global economic crisis. But as it stands now, I think everything does not point to that yet.
Wow, great stuff. Where does it now leave African businesses? We're always in need of cheap funds, debt cancellations, and of course, subsidies.
I think now Africa is not looking for debt cancellation any longer. We are looking for debt holiday, because the Western world don't want to give us debt forgiveness. Again, they want to give us debt.
Because they believe we are rich.
Because they believe we are rich, and they believe that we are mismanaging our resources. So what we need now is debt holiday. So give us time to be able to get ourselves on track, make sure we are not paying so much debt, and capital expenditure is not going on to galvanize the economy. Especially Africa is a consuming-driven economy. So once the consumers are not able to participate in the economy due to shortage of liquidity, then it becomes a major challenge. And then we don't have capital project ongoing to make people employable, especially those that does not have the technical skill to do the white collar job. So casual workers. So you need to give us debt holiday so that we begin to enjoy that with them. From there we get ourselves, because we are coming up from the pandemic, we've not recovered. And African currencies are not doing well globally, and again within, especially with exchange to the dollar. So we need to begin to ask for holidays. Now, how does that affect the African man? Like you said, it has affected investment in Africa so much that that's what you can just zero it down to Nigeria, and you see the crisis in terms. If it was before, we go to a Euro show, Eurobond show, we sell our Eurobond, we attract FX into the economy. Nobody wants to do that any longer. Foreign investors are not ready to participate in your Eurobond. Not only Nigeria, but Africa as a whole, because they believe that you have a structural challenge. And that structural challenge has to do with your currency, and also it has to do with liquidity. There's no liquidity in the system because of 90% of the African countries are involved in debts management. So you don't have so much to even involve in capital project. So all you need to do is to service your debt, and what is left in debt is to pay salaries. And if those salaries are not enough, then it's to borrow internally again. So you have a crisis that's externally driven and internally driven. So we don't attract those kind of funds, and that's dangerous to expand for growth expansion in Africa. And that's why you're seeing that IMF, World Bank prediction on Africa it's very good, it's very low.
It is. And I think there's even a review. Again, they are just trying to always read, but I can understand with all of these issues, the review must be almost a constant thing. Back home, Nigerian market has been recording market corrections, I think, since August. Yes, and let me ask you, what do you think is running through the minds of investors at this time about local markets?
Well, our local market is fine. I tell people that if the local market ends at the current price, I think it's still good. Because you can expect the kind of capital appreciation we've seen in some equities. And you don't expect the stock market, like you normally say, the stock market cannot continue going up. There must be that thing. Now, what's happening to our local market? We will not get those long bullish runs that we used to get before. So when there's this slowdown, then people shout, it's market correction. People are not looking at price correction. When you talk about market correction, you are saying that, oh, most of these equities are overpriced at the present price. But no, I don't think they are. It's not market risk. Most investors are reshuffling their portfolio. At this time, it's always like that when you get towards the end of the year. And when the third quarter result comes in, you see more of what people call market correction. Rather, it should be portfolio reappraisal. A lot of investors are beginning to move from, when you see the third quarter result, then you begin to say, look, what is in terms of capital appreciation and liquidity, in terms of dividend payout. That's what investors begin to look at. So as it stands now, our market is going towards what I call portfolio reshuffling, and then you can add it up again, profit taking in some other equity that investors feel that, look, some of this equity has coming from at the beginning of the year, we're selling as low as 8 to 7 naira, and now they have gone as high as 18 to almost, some of them are selling about 20 naira. So investors are beginning to look at, okay, can I take profit and then hold it on and look for opportunity to come in after collecting interim dividend. You mustn't forget that some equities also have paid interim dividend. So it's not basically market correction because of whether they are overpriced. I think it's portfolio reshuffling. A lot of investors are beginning to spread their risks and beginning to look at liquidity as king rather than just holding on to capital appreciation.
The banks still look very attractive, or remain very attractive.
They will definitely remain always attractive because of...
and they're still making a lot of money.
They are making a lot of money, and also the exchange revaluation have made them also have so much non-interest income in terms of dollar liquidity. Even if those liquidity are not right here in the system, they are almost offshore. So we must correct that also. But again, in terms of their profit after tax has been very, very good. So the banking stock is still the toast of investors as it stands, especially in terms of dividend payment. In spite of all the challenges, they are still paying dividend, and some of them up their dividend, especially the tier 1 bank. With the exception of Access Bank, all other banks up their dividend. Like GTCO used to pay 30 kobo, they pay 50 kobo. Zenith Bank used to pay 30 kobo, they pay 50 kobo. Even UBA shock investor, UBA used to pay between 20 kobo or 20 kobo. They are paying about 50 kobo. So it's really excites the market, and you have seen the movement, especially in the price of UBA. So definitely the banking stock is still the toast of investors. But again, investors are very cautious because you wouldn't know, we don't know the clear policy direction of the CBN as regard FX. And when you snip around.
Yes, that's it. We are ending up on that note. The FX and inflation, how it affects the market.
As simple as short, you don't have foreign investors coming. You won't get the long bullish run. Inflation have not really affected the market, funny enough, because again, when you look at it, you want to hedge against inflation, then you come to the stock market. Like I just said, some equity have gone about 100%, some have gone 150%. That is way, way above inflation. The only time you begin to think about the inflationary pressures, then you begin to look at in terms of dividend yield. Have the dividend yield from some of this equity have been able to meet up with inflation? No, but in terms of capital appreciation, then when you put the capital appreciation and buy by the dividend yield, you realize they have really, really beat off inflation. So the market have gained so much in terms of inflationary pressure. A lot of investors are coming in there.
I must thank you so much. Interesting conversation as usual, and it's really nice having you in the studio. Let me get that handshake and have a great weekend, Mr. Muktar Muhammed.
Thank you. Always
Mr. Muktar Muhammed is the Chief Executive Officer, Finance with Muktar. Thank you so much for breaking it down for us. Do enjoy your weekend again.
Same here.